Okay, hello and good evening, everyone. Thank you for joining our session today about our new REIT Plus portfolios. And we have a huge number of people already joined, the highest number of signups ever. So I think it seems like there's good interest. And I'll be the host for tonight, and I'll be taking your questions. And but for now, we'll start with the presentation by Dhruv. And with this, I want to hand over to him and quickly ask you to introduce yourself also.
Thank you so much, Sebastian. Hello, everyone. Thanks for joining for our webinar. As Sebastian just mentioned, this is the highest number we've seen. Which gives us a lot of encouragement that we've built something that users do like and users do want to know. I am the founder and CEO of Saif. Started building Saif back in 2017. But by the time we built a product that we wanted to get out to our users, and we launched, it was already 2019. From there, we've gone strength to strength, and one of our most recent addition has been the REIT product, which is what this seminar today is all about. So without wasting much time, let me just get straight into it. Great, yeah. So at Saif, essentially when we started last year, our first product was a global product, which was diversified, across assets, across, geographies and across industries, right? And the focus of this product was towards, have some sort of diversification away from, Singapore, because, as I always say, our jobs are here. Some of us have homes here, we have CPF here. I think it's very good to diversify outside away from, there's too much of concentration within Singapore for most of us. So the advantage of this product was it was USD denominated, and it gave a broad exposure globally to, bonds, equities and gold. There is a whole, session we can do on that product, but that's not the topic today. What we will talk about today is about obviously the Saif REIT Plus, which I'll touch about. And of course, as I mentioned in some of my previous seminars, if you've joined, we do have a full-fledged advisory team, which can help you with every step, whether it's, financial planning, understanding which global product is right for you, understanding which REIT is right for you. So let's try to keep this interactive. I would love if you, keep on popping in questions. In wake of the number of users, we'll probably have some segmented breaks where we address, those questions. But rest assured, I will be here as long as your questions are there to be answered, right? So, bear with us because there's a lot to go through. But, Sebastian will moderate and get back to you some answers on chat. And where relevant, he'll pass them on to me. All right. So let's get straight into what we have built now with Saif REIT. Now, as some of you might know, right, like the REIT market in Singapore is actually quite interesting, right? I mean, it's the largest REIT market in Asia after Japan. There are 44 REITs, and it's quite interesting that almost about, depending on the day, somewhere between 25 to 30% of the daily exchange volume on the SGX is REITs, right? That's just an indicator of how popular this sector is, with the audiences, right? And one of the reasons why, we even build the REIT product, right? The other thing is that REITs are supposed to pay 90% of their, distribution income, as in whatever is their, taxable income, they are supposed to distribute 90% of it out. What that really means is that on average, right, you have REITs giving a dividend of close to almost about, 5 to 6%, right? Which is very attractive. And just the way at Saif, when we build products, we think from a user perspective. The global product was trying to address a need of diversification and, global exposure and so on and so forth. One of the key features of the REIT product is to add a level of passive income, supplemental income, which is over and beyond what you anyway have with your regular jobs or your regular sources of income, right? So it's quite interesting because Singapore is, become the de facto, hub for REITs in the region, right? And this is something why it also makes very interesting, both as a market, as an exchange, and also for you as consumers. It's a great place to be and to actually interact with the REITs that are listed out here. So REITs, some high-level characteristics of REITs, right? I mean, first and foremost, I mentioned one of the most attractive aspects of REITs is the high dividend yield. It's probably one of the things that really attracts many people towards it. The second aspect is that REITs are actually very liquid also. What that means is that you can essentially trade in and trade out very easily. And this is actually a very strong feature. If you are ever thinking of it as an investment angle, liquidity is very important, because we always believe that you should have your investments accessible to you. In fact, one of the most common mistakes I see with a lot of, I would say not so savvy investors is that they have a significant amount of their savings in cash. Even in Singapore, that number is close to 45 to 50%, which is a fairly high number, right? And if that number can be reduced and invested correctly, it's a very, very powerful tool. And one reason why sometimes people don't invest is because they say, oh, what if I need money? Fair point. You might need the money, which is where, the liquidity comes in. You can really enter, exit, on the go. So it's very, very easy, right? REITs, of course, are more riskier than, I would say, conventional bonds, but they are also considered relatively safer than, conventional equities. And the reason is that in most cases, if not all cases, they have almost all of their net worth, attached to, assets. They are physical properties that, you've seen, whether it's malls or whether it's, residential or whether it's hospitality, as the case might be, right? Which is also the reason why they've traditionally had a history of outperforming the broader, STI index. I think the only one thing which we should also highlight out here is that at the end of the day, we are still, plugged and played into the concentration risk of having a single asset class, which is real estate, right? So I would not recommend individuals to have their entire net worth into a REITs asset class, but I think it can be a good portion of your broader, investment horizon, right? So be careful. There is a concentration risk, because after all, REITs are land and, real estate on the whole, kind of moves, together. So there's a little bit of lack of diversification from that angle, something, that you should be cognizant of as you start your investment or you continue on your investment journey. Great, yeah. So let's get to what we have built. Now, when we launched REIT Plus in the month of Feb, the response actually took us by surprise. The last 3 months have been the best months we've had as a company. Month after month, we've been, hitting new highs, and which actually made us realize that there is need of building high quality products in this sector more than what we originally anticipated, right? We launched with a variation of a REIT Plus, which we talk about, was a product where we were essentially having REITs with bonds with risk management. But the process of the selection of REITs was largely driven by our investment team, which, by the way, is extremely qualified and more than sufficient to do this on their own. But what we realized was that as we were interacting with industry participants, including the SGX, we came across a very, very interesting index, which is the iEdge S-REIT index. Now, this is probably the de facto benchmark for performance of the real estate sector. We saw blogs, we saw newspaper articles, we spoke to a lot of our users, and they said, hey, is it possible to access this benchmark? Because there is no product in the market that you can access this with. It's beautiful. I mean, it's just got 20 components, but still very well diversified, chosen REITs, but there's no product to access it. So the first thing we did was, we SGX, we've been speaking for a while, and we finally got in a partnership where we thought we should offer this product to everyone. This should not be an exclusive product to the ultra high net worth individuals or just the institutions. It should be available, to everyone, right? And what we also did, which was part of the other feedback we got, some of you loved our aspect of risk management, and I'm a big fan of it, and I will show you a bit about how that has performed. But some of you said, we just want pure REIT exposure because we have our, safe assets, whether it's, the SSBs or whether it is, CPF or so on and so forth. They are a set of, assets that I want, where I'm willing to take a higher amount of, risk on my side, and I want to clean, REIT exposure. And that is something what we imbibe when we thought, how should we enhance and make this product better, right? Which now brings us, for the first time, offering two choices. Now you have a choice of choosing either a 100% REIT product or the same risk managed REIT portfolio that we used to offer before. Now, bear in mind, if you were an existing customer, we have actually chosen the way we will choose and the way we will show you REITs will be exactly the same way it is done in both these pieces. So the REIT component, whether it is in the 100% REIT or the risk managed portfolio, is exactly the same, right? Now, the only difference, of course, is on the left-hand side, as you can see, is a 100% REIT portfolio, and we'll talk a bit more about it as we go on. And on the right-hand side, what you have is a risk-managed portfolio, where the minimum amount of REITs will be 50%. It can go up to 100% as well. But what we do is when markets are volatile, we will decrease the REIT allocation and add bonds. And by the way, this has paid off extremely handsomely to any customer who had invested with us in the month of Feb. We actually did the rebalance in early March. And I will show you a chart later on the performance, right? So you will see the difference between these two means. But what we realize is users essentially now have the power to choose whether they want a pure REIT exposure or they want REITs with an aspect of risk management, which in many ways is the premise of SAIF, right? If you've seen our global portfolios, if you've been on our website, our premise is basically on risk management over return management, because we believe risk is the only thing you can really control, right? I mean, returns you can't, right? And I can go on hours and hours about it, but in wake of time, I will get on to the next slide here. So what is the iEdge S-REIT index, right? I mean, this was created by the SGX to track the 20 largest and the most liquid REITs that are listed on the SGX, right? They've had a very attractive dividend yield of 5.1% last year and have continued to show very strong capital appreciation, right? How they decide end up this REITs is actually very critical. The way these REITs are chosen is basis of, they see the free float, they see velocity, and they see, with a 10% cap, like there's no REIT. I mean, there's a little bit here and, room, if sometimes prices rise, it might go a little bit over, but when rebalances happen, they actually bring it back in, right? So, which is great because, God forbid, any one particular REIT, there is something extremely negative, it will not impact your entire portfolio the way, if you were only invested in one REIT. And, diversification is a very, very powerful tool. So this is a great way to diversify, not just, between the different sectors of REITs, whether it's industrials, hospitality, or retail, but, on the whole, even you're removing your risk of just focusing on one particular REIT, right? One very interesting thing is that they use a leading standard, which is called the FactSet RBIX, to actually select stocks. Now, the selection procedure and how we choose, this is a much, longer discussion, and how, the actual index team chooses. So if you, give me a second, I can take you on to the next slide and tell you a bit about, the indexing team at the SGX, right? So SGX has been doing incredible work on the indexing space, right? And iEdge was formerly known as the SGX Index Edge, right? Simon, who's been an incredible help in building and helping us launch this product, heads that team. In fact, there is a seminar which is next week, which is with SGX, where Simon will be alongside me. It'll be largely led by Simon. And if you have true questions about, what is the methodology or why certain, REITs are in or out, I think that'll be a great time to actually, ask him, right? So the reason why I'm saying all this is that we do have the skill set and the capabilities of doing it. What we realize is that the SGX team, they are the experts, and the iEdge index is the benchmark. So it works really well because, they have their expertise in terms of indexing, and we have our expertise in, building a product and, optioning, risk management, and so on. So, it's a very good match for both sides. But if you have more questions and if you want to understand a bit more on how this indexing works, or how essentially they choose, that's a great time to go and ask them. One thing though I can tell you is that the rebalancing of this index, happens twice a year. So it happens in April, which there was the last rebalance which happened a few weeks ago, and the next time will be happening in October. But if you have some more questions, feel free to pop them by. If I'm capable to answer, I definitely will. Otherwise, please join us on the webinar, which is on the 5th of May, which is next Tuesday, where you can ask Simon himself. Great, yeah. So a few interesting facts. Portfolio currency, of the index is SGD. It has 20, constituents. Last 12 months, the yield, is about 4.6%, and the market cap is close to about $67 billion. Now, this is very interesting, right? Because this is how liquid and how powerful this index is, right? So unless you are trading, $5 or $10 billion a day, which you are, and if you've still dialed onto this call, thank you. I feel very honored. But the fact is that it is so liquid that even if you're trading a few $1 million a day or tens, 20s, a few $100 million a day, it should absolutely not make a problem. So that's a very, very good fact to keep in mind. And, a lot of people ask us, what are the top, constituents? You can see on the left-hand side, right? The S&S is, the top constituent right now, along with Capital Land, the Maple Tree family. We also have Keppel, DC, and Suntec. And if you can see, right, the properties, they're all properties which, whether it's Maple Tree Business Center or it's Vivo City, the Changi Business Park. It's a bit unfortunate many of us might not have been able to visit these places recently, but these are definitely familiar names to you, right? So essentially, as I said, one of the things that I personally like about the real estate sector, and something I like about tech stocks for that reason also, is that there is a look and feel to some of the constituents. It's all not just a black box, right? So you know how real things are, and you know they're physically present, as the case might be, right? But this is just for your knowledge to see what the top 10 constituents are. And which brings me to what we now offer in terms of their offerings. I briefly mentioned about this earlier. We have the 100% REIT portfolio. Now we have a risk managed portfolio, which along with the 100% REIT portfolio, you can toggle at any time you like. Now, let me quickly just do a little bit of a deeper dive in each one of them, right? The 100% REIT portfolio, it 100% consists of S-REITs, and it tracks the SGX's S-REIT index, as I mentioned, right? The annual return last year was spectacular, right? I mean, 27% return, 5.1% dividend yield. And as we mentioned on the previous slide, it gives you access to the most tradable REITs in Singapore, including REIT, MCT, Capital Land, Maple Tree. The names you've probably heard of, right? The other aspect, of course, is the risk managed portfolio, which is our bread and butter in terms of risk management. This obviously then combines the S-REITs with the Singapore government bonds. And as I mentioned earlier, the REIT component is still contained in the same way. It is still managed, the same way as the REIT portfolio is controlled, right? The annual return for this portfolio last year was 25%. The dividend yield is slightly lower, and the reason for that is because, of course, it's a component of bonds, right? So the way how we typically see a risk managed approach is that the fact is that, REITs obviously at the end of the day can be volatile and they can move up and down. And if you can stomach, that 10, 20, 30% spins, by all means, 100% REITs is the right product for you. But for a lot of users, they can't take that aspect in. That is where, we recommend a risk managed approach, where essentially you can choose your REITs, but every time the markets get volatile, we will decrease the REIT component and add bonds, right? So think of it, you're still getting your passive income, but you are essentially, somewhere preserving your capital. And that, to some aspect, gives some level of comfort to a bunch of users, right? And this is the SIFE's, RE methodology, which we talk about, automated risk managed investing. So what we do is every day we run simulations, and if we see that your portfolio is on the higher side of risk, we will cut down the REIT allocation and replace it with bonds, right? Similarly, when markets get a bit calmer, we will decrease, the bond allocation, and we'll increase the REIT allocation. So think of it as like a smart, kind of balance, which keeps on going. Bear in mind, as I mentioned earlier, even in the risk managed approach, we have a minimum floor of 50%, but of course, the maximum can go to 100%, which it has in certain durations of time. And you can switch between either one of them. There's a simple toggle on the web app. You can simply, switch at any point. There's no extra cost. We obviously recommend people not to switch very often because it defeats the purpose of, either you having a view on 100% REIT exposure or us being able to manage risk. So, stick to one approach and, stick to it, believe in it. If you're not sure which one is the right one for you, feel free to speak to our advisors, right? They are non-salesy, there is no entry, there is no exit. Some aspects I'll touch on a bit more later, but you have the comfort out there to decide what is right for you, right? This is a very, very powerful aspect, right? And I think this is something which we've always wanted to empower our users. We don't only want to be transparent and cost effective, we want to build products what our users like. And this is an offering of their products. And as I mentioned, this is the first and the only product right now available which allows users to access the S-REIT index. One quick update we normally get asked is how, does SIFE perform, in times of, how does the RE perform, right? And as I showed you on the previous slide, right? Oops, bear with me. On the right-hand side, we have the risk managed approach. So people ask, how did the risk managed approach perform? And this is a real example, and we have showed you numbers till pretty much yesterday, right? So if you had basically gone for a pure S-REIT index, there was a period of outperformance, which does happen. If you look at that span, which was, I would say, somewhere in the first week of March, and that is when we had done our first rebalance. If you can see, we came down on the 2nd of March from 77% REIT to 50% REIT, which was the lowest floor. And some users reached out to us and they're like, oh, why are you selling? And, I want REITs and so on and so forth. By the way, that's when we realized some users always want REITs. But that was one of the best decisions we made, because what happened after that was, as many of you have seen firsthand, there was a significant correction in REITs. But because we had cut down our REIT allocation significantly, our portfolio, well, it did correct, but only marginally. And if you see, from a base of 100, our portfolio is only down about 5 or 6%, whereas a pure, REIT portfolio even now is probably close to about 17% down, right? So bear that in mind. Again, I think every customer has a different use case, and if you're not sure, we can help you identify. But there are merits of risk management, and if you have, if you think the REITs is your relatively high risk asset where you want a pure REIT exposure, now you have the option to choose 100% REITs, and that will not get risk managed, right? But this has done extremely well, and even some of the users who cribbed and who told us, oh my God, what have you done, and so on and so forth. A couple of weeks later, I think they were thankful to the approach we followed, and that's why we've hardly had any withdrawals. If anything, we've just had consistent inflows day after day, because in this entire wave, we've ended up saving our users a significant amount of money, and building trust and re-emphasizing the faith of the beauty of the risk managed approach, right? We do seminars which deeply dive into our risk methodology and RE. That's not the context of today, so I will avoid really getting into it. But if you want to, feel free. There's a white paper. There's a lot of research that we have on our website. If you have any questions, feel free to drop us either an email to me directly or to our support team. And definitely attend one of our RE webinars, which happen every few weeks, so you can ask us more specific questions. One big question we get asked is that, why should I choose a REIT plus approach, either risk managed or 100% REITs versus a DIY approach? I think the reasons are endless, right? I think the first and foremost, as I mentioned, I think for the first time we are offering the SG REIT index. It doesn't exist, right? I understand there is an ETF which offers exposure to REITs, but it's not tracking this index. And if you look at this index, I think it's because they have a choice of choosing the REITs, they end up choosing the most optimal needs, whether it's from a Sharpe ratio perspective, whether it's i.e. a risk reward perspective or a dividend yield perspective. It's incredible, right? There's of course no minimum investment. Also bear in mind, there is no require of CDP or brokerage account, right? I mean, you can just invest in SAIF and we do it. The time you require to onboard is basically now come down to under 3 minutes using my info. And very importantly, we offer you that option of risk management should you ever want. So let's say you're 100% REITs, but you're feeling a bit jittery and you're not really sure what to do with the markets and all. You can choose to activate just a toggle switch, no extra cost within your portfolio itself, right? And then this is automatically rebalanced and re-optimized with no intervention required from your side. We will tell you every time we rebalance or re-optimize, so you are aware what we are doing. The other really interesting aspect is automatic dividend reinvesting. And we've built a feature on our side where customers who are in our Black and above program, Black are investors who put more than $20,000, you can choose to get dividends paid out to your bank account every quarter. But the de facto behavior is reinvested. So you get dividends in both cases. In one, you can choose to get paid out to your bank account. In one, we just reinvest, which you can, again, withdraw at any time you want. One very interesting statistic, we ran some numbers across the last 5 years. If you had reinvested, you end up making on average 0.5% or 50 basis points extra every year. And this is very important because if you just reinvested your dividends, you've actually already paid up for fees. But you can't really do this reinvestment methodology even if you have $100,000 invested, because what you will get is going to be a small dividend, which will not really justify you to pay the $10, $20, $30 brokerage, right? Or even hit the minimum requirement to do a DIY, REIT approach, right? But here, even if you get paid a dividend of $100, we will break it up. We allow fractional share ownership. We will break it up and replicate the entire index for $100 also. So it's a very, very powerful tool, right? There's obviously no brokerage fees. Our fees is all inclusive. And our fees, which I'll cover a bit more in one of the latter slides, is between 0.4 and 0.65% per annum, all inclusive. Similar strategies, whether it's an ETF or advanced risk managed strategies through funds, charge anywhere between 0.5 and 1.5%. And there is a brokerage element more often than not on top, right? So from a cost angle, this is actually incredible. It's a very, very powerful tool, right? Something to bear in mind, right? Great. With that, before I get on to how to start, I can see there are loads of questions. Sebastian, can you help aggregate some of them? And let's address a few questions before we tell users how can they kickstart with their journey at Saif.
Absolutely. And as you said, there's many questions. I've tried to answer a few already, but still many more to go. So let's get started. There's another question which you already answered, but I just wanted to add something, which is about switching between the different REIT portfolios, so the risk managed or the 100% REIT. This is, as you mentioned, very easily possible just with one click. Please be aware that this is currently not yet available on the app. You need to do this on web, either on your mobile or desktop. We will be adding this soon.
And there's no cost to do it, Seb. Just to add, there is no cost to do it. It is included in your fee, so there's no extra charge. Just a simple toggle on your side, and we will switch it for you.
Exactly. You mentioned earlier that there is a 90% distribution of income, and the user is asking if there is any expiry until this is valid.
Well, not that we are aware of. I think this is one of the reasons why REITs are very, very attractive, right? If they ever expire, I think most people will start, selling out. But typically how REITs are structured, not just in Singapore, even in a global phenomena, they are supposed to pay out their taxable income as dividends. See, a lot of people think of REITs as an alternate way to be a landlord, right? I mean, you're basically you end up buying like a few $1,000s in a property when you're buying a REIT in some way, right? So essentially, if they are managing it and you're getting some kind of, and taxable income, i.e. your kind of rental income, you need to get that paid out. So if they change that logic, I think the attractiveness of REIT will go away, but it's extremely unlikely, let's put it that way.
Yeah, and I think recent regulations rather try to make the sector more attractive than the opposite. So I think there's no indication that this will change anytime in the future.
Sure.
There's another user which asks if there's any global or Asia REIT planned. I would answer that we want to focus on Singapore because we already have a global product. Would you agree with that?
Yeah, definitely, right? I mean, our goal out here with the global product was if you need diversification, you need global exposure, right? The goal of the Singapore income was passive income and give you Singapore dollar exposure. The time you start getting global exposure, there are currency risks and other aspects which start coming in. So it's not on the pipeline. Haven't seen 12 months down the line, but it's not on the immediate pipeline, if that's your question. Yeah. I think we've had a little freeze with Sebastian. 1 second.
Had to come asking about it. Hear me again? Yeah, hello.
Yeah. We lost you, Sebastian.
Can you hear me again? Yeah. Yes. Oh, sorry. Yeah. One question which had to come is obviously about COVID-19 and the impact on the REIT sector and the markets overall. Can you share a bit your perspective on this?
Yeah, it's a great question. Yeah. So, I mean, I think there is no denying that, of course, there will be some impact on the sector, right? But if you see the couple very interesting things what have happened, I think the government has come back and offered some really incredible stimuluses to these companies, right, across the board, right? So many times when companies are passing on something to their tenants, between 1/3 and 1/2 is actually coming from the government, right? The second thing to bear in mind is that what is your perspective with the sector? If you are coming with a view of like 1 month, 2 months, then expect some volatility. But if you're coming up with a longer view, unless you expect the situation to last for years at play, I actually think that this might be a great time to get invested. And the reason why I say this is that, as I just mentioned earlier, the broader sector is almost down about, I mean, at its peak, it was down almost 30%, but it's still down about 15 to 17% from the highs. So a fair amount of this impact is already getting priced into the REIT prices, right? So if you're buying REITs today, on average, you're buying them significantly cheaper, right? When I think about Singapore, I think about the REITs we are in, we still are, a limited geography area, right? So there are only that many, retail and that many residential and that many commercial properties that are coming into play. So it is possible that some REITs might benefit and some might lose out. And that's why actually I would be very scared of taking a bet on a single REIT. I mean, by all means, if you have done your research, go ahead and do it. But as a diversified exposure, and if you think of it, as a holistic perspective, I think they're always a great buy. And I want to believe that where we are today and where we will be 12 months down the line will be a much better place than where we are today.
Great, thank you. I think that was a very common question by our users. Let's continue to something about tax, and a user is asking if there's any tax implications which reduce the yield. And I think I'm right to say that this is one of the great things about REITs, that there's no further taxes, there's no withholding tax or anything like that. And it's basically, the dividends are basically tax-free income.
Absolutely. Whether you are an individual or whether you're a Singapore-based corporate or you're a foreign individual also, I think it is completely, tax-free. In certain cases, if for whatever reason, if a tax is held back, rest assured, SAIF will 100% get that claim back and give it back to you. So there is no taxing liability at all in REITs. Whether you're a Singaporean individual or whether you're a foreign individual or you're a Singaporean corporate for that matter.
Okay, and then there are two questions which are again about switching between different portfolios. Yeah. This time not about how to do it, but more about how does it work? Like basically, does this mean you're selling certain REITs and are buying the new ones? What is the valuation of those REITs? And yeah, how are these portfolios generally priced?
Sure. So it's extremely transparent. If you move in your funds before 11 a.m. on a particular day, we end up trading the same day. We will actually end up buying the REITs in the second half of the same day. We, in fact, show you the price at which we bought our REITs. We are completely transparent. You will see the price at which you have purchased, each individual REIT, and how does that constitute your portfolio. This is available on your dashboard as soon as it happens. We also send a month-end summary of this. So you have complete transparency as to the price at which you've bought and price at which you've sold, right? So let's take your two cases. What happens in the two cases? Let's say you were on a risk-managed approach, which was 50% into REITs and 50% into bonds. What we'll end up doing is we will sell the bond, and the 50% we will buy as per the REIT index and move it, make it 100% REITs. On the other hand, if you had 100% REITs and you want to move to a risk-managed approach, we will sell 50% REITs and we will, buy for that 50%, we'll end up buying bonds, right? And this both happen the same day. What you have to keep in mind is that I have used an example of 50%, but as I mentioned, in the risk-managed approach, the composition of REITs can vary between 50 and 100. So in Kama markets, we actually might even move to 100% allocation. Traditionally, we've seen over a long time, it's roughly about 75% REITs and 25% bonds. Currently, because it's volatile and we did this incredible rebalance that I'm quite proud of, currently the REIT allocation sits at about 50%.
Okay, perfect. And I think I will answer this additional question here. So in terms of valuation of these REITs, right? They're all publicly traded. They're all traded on the SGX, so you can see the value of these REITs in real time by going on any online platform such as Yahoo Finance or something similar, right?
Absolutely. We only trade listed REITs, right? And again, as I said, the IH index, right? I mean, they have very high standards in the way they choose REITs, and liquidity and velocity and all those become very important aspects, right? So there's 100% transparency in building that out.
Okay. Then there's someone asking if it's possible to invest in both portfolios at the same time. And the short answer is yes. You can even create multiple portfolios of the same portfolio, right? If you have different objectives or different goals. If one objective is your retirement and the other objective is buying a holiday home in 10 years from now, then you can have different portfolios for each of these objectives, either of the same type or of different types.
Yeah, and I'll just go on to add, like, there is no minimum for any portfolio. There is no, like, rule, or there's no cost for any additional portfolios. So feel free to have as many portfolios as might be relevant to your case, right? I think we have one customer, I don't know, who has, I think, like 24 portfolios. But on average, we typically see people have about anything between 3 to 4 portfolios, because they have the global and then they have REITs, and typically 1 or 2 in each is what we've seen.
Okay, and then there is someone asking, is there a prospectus for the index, and anything where he can read about the short and long-term outlook of it?
Absolutely. I mean, the SGX publishes their prospectus, which you can find on the SGX website. If you search for this index name, you will come up with a lot of information on that. And as I said, you can feel free to have a talk with Simon Cabran, the man himself behind the index, who will be joining us for a webinar this Tuesday. So, both approaches are accessible to you.
And then there's a very interesting question by Kendrick. Kendrick is asking, there's a 2.1% delta return over the managed portfolio, the risk managed portfolio versus the 100% REIT portfolio. And he's asking, why would anyone invest in the 100% portfolio?
Yeah, well, I mean, Kendrick, I think, it's a good question, right? I think if you look at one particular year as an example, right, then, of course, from that angle, it makes a lot of sense. But there are other cases and other situations where if you look back in data, and there'll be some years where the outperformance might be, higher or lower. We do have a slide on the performance difference between the two, right? I think this might be relevant to just take to that. What do you think, Seb? Should we just get onto that slide, or?
Definitely.
Yeah, let me try to see if I can find that. Bear with me. Okay, 1 second, everyone. Okay. Is that something that you can see? Can everyone see this? Do you see that?
Yes, I think that looks
so
good.
If you see, right, I mean, the advantage comes across, in certain situations like 2012, right, where there's a significant outperformance in the REIT index, right? But if you look over time, I mean, our view is that, the risk managed approach actually ends up making more sense, right? The only thing is that, if you're doing that, then be prepared. You will still have some, you might lose out on those little 2014 and 2016 rallies, right? So as I said, right, it's a very case to case thing, right? I mean, I personally like, a risk managed approach. But let's say if I end up investing a lot in safe assets like the low risk global portfolios, etc., it's possible I might end up choosing a complete REIT portfolio out here. So it's a very case by case thing, and that is something which I think varies as per the individual.
Okay, then there is a question which goes back to the one which we talked about earlier. If you have multiple portfolios, and there is someone asking if you have one risk managed portfolio and 100% REIT portfolio, is there an overlap of assets between the two portfolios? And I will try to answer this question directly. The answer is yes. The REIT portion of each portfolio tracks the IHS 320 index, and therefore is similar, right? Or is the same between the two portfolios. The difference is that in the risk managed portfolio, we then dynamically will increase the share of REITs and government bonds in the portfolio to manage your risk, right? Yes, so it means there is an overlap, but I think that's an overlap which is actually wanted, right? Sorry.
Just to reiterate, like for majority of users, the REIT portion is exactly the same in the two portfolios, right? I think with the risk managed, the only difference is that we can, increase or decrease the composition of REITs and, add bonds to balance out the impact, right? Which does end up paying up in times like, this particular case out here. And this is a real example, which if you have any of your friends or anyone who has invested, this is what they have experienced, right? So we've actually publicly quoted these numbers out, and these numbers are till yesterday, right? It's not like choosing a specific time period, right? So it's quite powerful. But it depends what you want. Again, if you want a pure REIT exposure because that is what you want to do, then by all means go ahead and do it, right? So we have enabled that option to our users because every user is different. Their use cases and requirements are different.
Yes, and then there is one question: how long does it take to switch between the two portfolios? I think you already mentioned earlier that the cutoff is at 11 a.m. So if it happens until 11 a.m., it happens the same day. If not, then it happens the day after. And yes, so then it's basically, this is the answer to this question. What about the rebalancing? I think you already mentioned that.
I think we've Seb has frozen. Let me answer the question about rebalancing. So one is the rebalancing of the REIT component itself, and the REIT component rebalancing is essentially done twice a year, which is done by the SGX, which happens once in April and then once happens in October. The REITs with risk management, in that case, we end up rebalancing based on the frequency when the portfolio becomes risky enough, right? So if your question is for the REITs with risk management, that rebalancing is a function of completely how your markets how the markets are. Is your portfolio becoming too volatile? If it becomes volatile, we will rebalance. Like here you can see we rebalanced in a span twice in a span of 2 weeks, but there's nothing happened after that, right? Historically, we've seen the rebalances typically happen between the REITs and bonds maybe twice or thrice in a year.
Okay, thank you. Cecilia is asking if this is a new product that is yet to be launched or an existing product with existing NAV. And she's asking this because she already can see the returns here. Can you clarify this for us?
It is an existing product. We've had the REIT product live from the month of Feb. We switched to the index the day our partnership with SGX was officially announced, which was on Tuesday. So effective Tuesday, this Tuesday, which is 2 days ago, customers are actually already accessing and trading this product. And we've had an incredible amount of interest with this new offering. So you can go up online right now and you can end up interacting and transacting with this platform right away.
Okay, someone is asking about how dividends are paid out.
Sure. So we end up passing all the dividends as we receive straight away to the consumers, right? No tax withholding and all, as I've mentioned before. Dividends by design end up getting reinvested in your portfolio. If you are a customer who is on our Black or Gold programs, you can choose to get these dividends quarterly in your bank account as well. My recommendation, however, is that unless you need the money, it's much wiser to reinvest it because it ends up giving you another 50 basis points on a year on average, right? So when I talk about my plans and the different options we have for our customers, at that point we can touch this point again. But essentially, you get the dividend the day it gets paid. You get paid into your account in a day or two, and you can choose to withdraw either the dividend, less, more, as you like, completely up to you. Right? So.
And there is a question which just came in, but I want to pick it up because it's about the current slide, which is a user is asking, on the 2nd of March, we rebalanced to 50% REITs.
Yes.
And then on the 19th of March, we increased the 45% of REITs to 50%. How is this possible when we just actually on 2nd of March, reduced to 50%? Why is it suddenly 45%?
Yeah, because
no, please answer.
Yeah, no, because the REITs actually corrected in value from that point, and you can see this. The REITs probably lost close to 10% of value. If you see this blue chart, you can roughly see between that and between the 2nd and 19th. If you look at the blue line, the correction is almost close to about 15% or so. So the REITs themselves lost value, so they became a much smaller part of the portfolio, and that is why it came to 45%. But because we have a 50% floor on REITs, we had to rebalance it up to bring it above 50%, which is what they are right now at.
Perfect. And I hope, if anyone still has a question on this, please ask again. I've seen that there's quite a few questions about this right now. A question.
should we pause for some time and move on, or are there a lot of questions on the current slide? How's it looking?
There are still a lot of questions, but I think it's actually, I've already told a few people that we will answer some of the questions in the next section. Let's continue maybe for a couple of slides and see if we can answer a few of their questions before they even ask.
Sure. Let us try to get through some of these slides so that, you know, they're not that many, I assure you. But as I mentioned before, you know, we'll be here as long as every question is answered. So rest assured, you know, if you haven't got your answer, you will get your answer. Great, yeah. So how do we start? It's extremely simple. It's basically just in 3 steps, right? The first step is just about risk profiling. It's about us to understand you a little bit better, understand what's your big risk tolerance. This you can do both either on web or desktop, or even through our apps, which are now both available on Android as well as on the iOS store, right? On basis of that, we will give you a portfolio recommendation. The beauty of this portfolio recommendation is that you can exactly see what your portfolio is before you even put your first dollar in. You can exactly see what the constituents are, what the weightages are. You can see everything of your portfolio upfront. You can even see historical dividend yield, historical yield, and so on and so forth, right? So very, very interesting aspects, right? And once you've done that, there is just a simple onboarding, which you can now do through Mindful across 3 or 4 minutes. And voila, your portfolio is ready. From that point on, you know, you have your portfolio, it is inactive. As soon as you transfer your funds, this portfolio becomes active. We have a beautiful app which you can use to monitor on a regular basis, see how your portfolio is doing. Is it going up, going down? You can see the current value, expected value, returns, all the relevant, you know, fields that as relevant might be out here. One other aspect is obviously, you know, and I think it's a very important aspect, is about security and safety and what kind of licenses that you have. So Saif actually has the fund management CMS license which allows it to take retail funds. And this is a very, very unique thing for us because there are only a couple companies which have it, which are not banks, right? So it's a very stringent license which comes from the MAS. You know, it took us over a year to get it. You know, we need to have internal compliance, external compliance. A Big Four is our external auditor. We have internal auditor. There are a plethora of things that, you know, require, and above all that, you know, a very high pedigree of team, right, which is a must for MAS before they assign this license to us, right? So given with the license, there are also some stringent checks and measures which come to assure the safety of consumer assets. So a very interesting fact, you know, is when you transfer funds, you're not really transferring funds to Saif. You're transferring it to a trust account at DBS, right? Even Saif's corporate bank is another bank. It's not even DBS. So it's completely segregated from Saif's own funds. And essentially, this is a trust account which is only and only for client funds, right? After that point, we end up, you know, trading with our broker, which is Saxo, you know, Capital Markets, whose sub-custodians are Citi for US securities. For REIT, it's HSBC. And, you know, that again is another layer of security. So the reason for you to know is that your assets, whether when you move the money into a trust account or they are held as securities, they're always held by reputed, you know, big companies and big banks and big custodians, which is completely separate to Saif. So which actually keeps and, you know, safeguards your assets, right? Which is very, very important point to note on our side, right? And then a question is like, okay, all this is good. How are you guys priced? So we could have priced our product in a really complicated way where we have site fees and index fees and management fees and brokerage fees and platform fees and XYZ. We thought, why don't we give one simple, transparent, price to all our users, right? So what we do is we have one price for our users, right, which covers all trading fees. There is no entry, no exit charges. You can even make partial exits. There is, or you can even take small money if you need out. There is no minimum balance. You can literally put $1. Why you will put $1 is a question I always ask, but you can if you want to. You can withdraw as much as you want, as little as you want, as many times as you want for no fee. We will rebalance, or you can choose your rebalance between toggles as much as you want. And in case of the risk managed product, you know, the ETF, which we use for the government bonds, it has a relatively very low fee attached to it, right? So if you choose for risk management, we've chosen the highest grade of, you know, ETF, which is extremely extreme, the NICO ETF. So I think it's almost got $1 billion under assets, and it's a very, very low fee ETF, right? So we've been very selective in the way how we, you know, choose these products, right? and what we end up offering to our users. So one, transparent, all encompassing pricing. Yeah. Which brings me to what exactly is our pricing. So we have 4 tiers, right? Which are the blue, black, gold, and platinum. As you can see, the fees as you increase your size actually keeps on going down. I mean, it starts at 0.65 basis points. So, but if you are over 100K, it goes to 0.4%. If you're a platinum customer over 500K, please reach out to us because we have a few of these customers now and they have specific needs, and we will be possible, it is possible for us to address your needs, right? You can see the minimum investment amounts which are associated with each one of them. One very interesting thing is that if you are on the black or above plan, you each even have access to our financial advisors, right? Which is incredible because our financial advisory team, I think it's one of a unique differentiator of Saif, is it's run by a pedigree of people who work at big banks, whether it's DBS, whether it's the Goldman Sachs, and we are essentially giving the real high quality service to our end users. As you can see in the previous slide, we don't really have entry or exit. So, none of the people who work in our advisory team have any incentive of doing, sales to you, because at the end of the day, the only way we benefit as a platform is if, you sustain and stay on our platform for a long time. So we are thinking of this as a long-term relationship, and that's why there is no entry or no exit, right? But by the way, if you're on a blue program, you can still get access to our financial advisors for the first month because we want you to experience and see how beautiful and how powerful they are, right? Lastly, if you are on the black or gold program, you also get a comprehensive financial planning session. If you're on the blue program, this option is available, for you as a paid alternative, right? And if you're in platinum, we can actually do this thoroughly across your entire portfolio, not just your side portfolio or your other non-invested assets for that matter. We are about close to 32 people and growing. We've in fact hired a lot of people across the last few months, and we continue hiring. But some of the key people, at least in our investment team, I think I would like to highlight. Richard heads our portfolio construction and risk management, comes with an incredible experience. His focus at NUS when he was an academic there was in portfolio construction and risk management. So it's a common theme you will see, especially in our global and our RE, our automated risk management methodology, is his brainchild, right? Where we all believe that risk is what we should focus on rather than returns, right? He was a senior director at Lion Global before, and also was the CEO of EOB Venture Management. And to be honest, there's not enough space on this slide, but I can go on and talk about Richard, right? Akiko is probably the smartest person I've worked with. She is a PhD and FRM, and she's a senior financial engineer with Saif, right? She is also, has extensive experience working in the industry at Tokyo Marine, so has been building quant models for quite a while now, and brings in an incredible angle to the team, right? And Ritesh, as I mentioned about earlier, heads our investment advisory team. He was formerly the vice president at Morgan Stanley for risk. Again, it's a team of risk. We're very focused on managing risk, but more recently, he was a private banker at Goldman Sachs, and some of the service that some of our clients get essentially is the Goldman Sachs level. I mean, we can't go all the way like the private banks, but at least when it comes to the quality of advice or it is the quality of product creation, we want to be at that level, and that is the promise we make ourselves every day when we go to work, right? And myself, lastly, right? Most of my career was with UBS, where I started as a portfolio trader and then went on to start the ETF distribution desk. This is, I'm talking like, not just the previous financial crisis, but including that, it was an incredible time to be on the trading floor. But after that, even seeing the whole China recovery, and as ETFs became popular, being at the center of it was an incredible time for me. So, constructing portfolios or, trading ETFs and managing risk, have all been topics which I have done at a massive scale. And somewhere when I started Saif, the premise was, can we take that level of service and using technology, democratize it, right? And that's why, all our technology, all our algorithms, everything that you see is proprietary, right? We've all built in-house, and as I said, we're almost about 30 plus people now and growing, all at your service. So I hope that is something which is good for everyone. And I've mentioned this about a few times, on our in our previous slides, right? But if you're not sure whether the product is right for you, please speak to one of our advisors, right? The first call is completely complimentary. Speak to them and see if this option is right for you. Extremely qualified, licensed representatives who've had experience in the industry before. So you are getting the grade A service, right? So keep that in mind, right? With that, I do want to say that thank you for attending. I will come back to Q&A, but there is a promo code if you complete the feedback form. The amounts are in front of you, which increase as you invest more. And all you need to do is scan this QR code, and it'll take you to a survey which you can fill on your phone. With that, I will pass the mic back on to Sebastian for more questions.
Yes, and I have tried to answer a few questions in parallel, but there are still a few left, more than a few, quite a few. And I want to start with the following. I think we have covered this, but maybe we should emphasize on how the dividends work. What happens if the dividends are paid by the REIT? And what happens if you are a black or gold customer and you choose for payout, or what happens if you opt for the automatic dividend reinvesting?
Sure. So just straight off the bat, no matter whether you are a blue or a black or a gold, you will get your dividends in all cases, right? So that is the first and foremost thing. As soon as the REIT announces, so let's say you have 10 shares of Keppel and they give $1 dividend, and let's say you have 10 shares in your portfolio, you will end up getting $10 in your portfolio. This doesn't matter whether you are a blue, black, gold. It is your dividend. It comes to you always, it gets into your portfolio, right? It basically, as soon as you get it, the first thing is it actually ends up getting reinvested, right? It completely gets reinvested and it's back placed into your portfolio, right? Now, when you are in a black or an above option, you have an option of paying out these dividends on a quarterly basis. What that means is that, and let's take a step back, when I said the dividends have anyway come to your account, again, if you're black, blue, or gold, or any customer, right? If you are on a blue or sorry, if you're in a black or an above category, you can choose to get these dividends transferred to your bank account on a quarterly basis. So rather than it getting or staying reinvested, it will be withdrawn from your account and it will be sent to you. Now, you can always choose to withdraw it anytime you want, right? So the question is, or the point to consider is, there is no difference in the dividend you will receive or the way you will receive the dividend, no matter if you're a big or a small. That is the same for everyone. Only if you are a black or above customer, you have an option to quarterly choose to get these dividends paid out into your account, right? So that is the only difference. And if this is not clear, please ask another follow-on question, and Seb, if that comes, please let me know, because this is very important to know, right? There is no disadvantage if you are a blue customer. The commercial terms are exactly the same. The reason why we only pay out to bank account for customers who have on a black or gold, because the dividends are meaningful in size. So let's say if you invest $1,000 and your dividend, for a quarter is $10, it's a very low value to pay to a bank account, right? That's why we put, like, if you have to be at least a black customer to get paid it to your bank account. But even if it's $10, you will still get it in your account, which will get reinvested, or you can choose to withdraw it at any point you like.
Thank you. There's a question about tracking error.
Yeah.
Actually, even two. And they're asking, what is the targeted tracking error for the REIT portfolio?
It's a great question. Yeah. So for those who don't know what tracking error is, essentially, because we are trying to benchmark the index itself, right, which is like, the entire concept of the index, tracking error is how closely you are able to match to this index, right? So our current tracking is at 99.5%, which is very, very accurate, which means just a small tracking error of just 50 basis points, right? Which for a Singapore listed, REIT-based product is an incredibly strong number, right? So it's at 99.5% accuracy. So I hope that answers your question.
Yes, I think that's an excellent question. There's a few questions about rights issues. Maybe you can elaborate a little bit on how we deal with rights issues by REITs.
Sure. So we keep a small cash component in your portfolio, which is used for everything from whether you want paid out dividends, our small management fee, or even subscribing for rights. We will end up auto subscribing for rights for you, right? And when we auto subscribe for rights, essentially that cash component gets used to subscribe for rights. Now, some people might say, "Oh, you only have 2-3% cash. Is that going to be sufficient for me to subscribe for rights?" Frankly, actually, it's quite high if you think of it, because if the biggest index weight is only about 10%, then 2-3% is almost as good as 20-30% what that particular component requires, right? So in a nutshell, we will auto subscribe for rights for our customers. If for some reason we realize that there isn't enough cash, right, at that scenario, we will uniformly decrease the portfolio a little bit, like by the same protocol, still tracking the index, generate enough cash, and subscribe the rights for you. Again, a beautiful advantage of doing it through us versus doing it yourself, right? I think it's going to be extremely cumbersome for you to manage that.
Yes, and then there is two questions which I think are excellent questions of examples of what you can discuss with your SAIF financial advisor, which is one, what recommendation do we have for someone who wants to have a global as well as a REIT portfolio? How much should he allocate to the global portfolio and how much should he allocate to the REIT portfolio? I think in our view, like this is something which really depends on your circumstances, and it's hard to give a general answer to that because we don't know your background and so on. But I think it's as I mentioned, it's a good example of something which you can discuss with your financial advisor, and he will, based on your individual situation, give you a recommendation regarding this.
Yeah, exactly. I think like it's very interesting, when you speak to an advisor, because we have spoken to thousands of people now, right? So there will be other people like you out there, which will have a similar profile, and we can use that information, our broader assessment of such information to help you understand, what is the right path for you to follow, right? So definitely have a conversation with one of our, financial advisors, and they are the best people to guide you, right? Because frankly, like just by knowing, there is no like standard answer, right? So it's a very case to case situation.
Great. And then there's another question. I think there we can give a very clear answer, which is, can I fund my REIT portfolio using a credit card?
My understanding is you can't. And I don't think either your credit card company or I think our bank will actually accept it. I know you probably want the points for the credit card, but basically there is a very heavy fee whenever there's a credit card transaction of almost, I think, depending on the card, between 2 to 3% sometimes. So it does not really justify sense. So the short answer is actually no. Also, I would not recommend people to invest on credit. I think it does not make sense because the amount of interest rate you pay on credit card is significantly higher than most investments can generate. If that was the angle you're saying, but most people are doing this from a angle of getting a few more points. So don't do it because let's put it this way, you can't do it right now.
Yes. Then we have a couple of questions, and I know I already asked you this earlier, but like there is still a few more questions where you're saying like, considering the current situation and the current timing, would you recommend going with a risk managed portfolio or going with 100% REIT portfolio?
So, we built SAIF on a premise of risk management, right? And I personally am a big fan of risk management because for me, I'm okay missing a bit on the upside if I can safeguard against significant downside, right? That's how I think, right? And this, everyone is different, right? And that is because, a significant part of my, savings is now invested with SAIF, right? So if for you, essentially, when you think of your broader portfolio, and again, maybe talking advisor can help, but if you think of your broader portfolio and you already have, let's say, relatively safe assets out there, whether it's, a CPF OA account or whether it is, SSBs or fixed income and all that, it might be suitable in your case to essentially, go for a higher, 100% REIT profile. So I'm saying that at the end of the day, right, I showed you in the chart, right, historically, if you look, and I think I have this chart somewhere here, oops, where is it? Historically, if you look, right, the difference between the risk managed and 100% REITs is not that much. Of course, there are exceptional years like, the one that we mentioned above. But of course, the advantage of, getting down is what happened in 2020, where if you are on a risk managed approach, you would have actually saved a bit of the downside. Now, generally, the word we use in the industry is most people are hindsight traders. Like, if it goes up 20% from here, everyone's like, oh, I should have been 100% REITs. So that's why, we've given you both the options. See what suits your profile better. And again, think of it as your holistic investment plan, right? But when you stick to something, I always say stick to something. If you keep on toggling between them very often, right, it probably defeats the purpose that you started out with, right, for that matter.
What is the investment horizon you recommend for a portfolio like this?
So again, like we have no entry and exit barriers, right? So you can come and leave in like 2 weeks, right? If you need the money or if this is not right for you. But typically for products like this, we see about 2 to 3 years at minimum is what people end up looking at, right? Again, you don't need to. I always say the longer you can be invested, it's always great, right? I mean, if you can extend your horizon to like, 10, 15 years, by all means do it. But I think at least you think from it from a 2, 3 year perspective, right? Otherwise, then it just becomes taking a very aggressive view on the markets. And let's face it, right? The next couple of quarters could be volatile. Now, could you pick up the bottom? No one knows. Just today, the bottom, no one knows. Everyone, was like, oh, this is going to go down high. It's going to rebound. It's going to go worse. Two weeks ago, everyone's like, it's going to go worse. But now markets have rebounded, right? So don't try to, how do I say, time the market. It's more about the time you have spent in the market, right? And if you have the luxury of spending time, and the word when I use luxury, what I mean is if you don't have an immediate requirement of the funds, the longer you can stay, invariably you'll benefit, right? And there's a lot of data on it. We covered it in one of our other presentations where, if over a long term you stay invested, you're always bound to win, right? And if you don't need the money, there is no reason for you not to.
Okay. There's someone asking if we can have a view of how many units I currently own. And I think that is something which we show in our dashboard, correct?
That's right. That's right. Yeah. You can exactly see how many units you own. You can even have transaction data, which comes in the month-end report at which price you own. So for example, you might have 103.2 units of Suntech, right? And that is something which you see. So it's very, very transparency. As I've always said, right? I mean, we are building this for, years and decades to come, right? So we pride ourselves in transparency, and at every juncture you will see we are very transparent. Even before you invest, you actually know firsthand what you're actually investing in, right? So we are always very transparent that way.
And then there's an interesting question about the pricing structure. The user is asking, is the pricing based on per portfolio, or is it the total amount invested under the user's account?
That's a great question. We should have covered it. It is a function of total amount. So, and that includes all your portfolios, whether it's global, whether it's REIT with risk, whether it's 100% REITs, is a total sum of all your investments, right? So let's say you're an existing customer who has $15,000 invested in into our global product, and you end up putting another 10,000. So we will look at the overall, which is 25,000, and hence you become in a black tier and are only paying 50 basis points or 0.5% a year. And again, this is a per annum number, so you only pay for the duration you are. So if you are there for 1 month, you only pay for 1 month. You only pay 1/12 of 0.5% for that matter.
Okay. There's a couple of questions around the dashboard, and what are maybe other things which are visible there? So there's one user asking specifically about buy and sell prices and transactions. Maybe we can elaborate a little bit on this.
Yeah, so you can see an example on this screen on the right-hand side, right? So there's a graph which shows you current value, what's your invested value, what was the return, time-weighted return, portfolio impact. Currency impact is relevant if you have invested in USD, but for example, if you're in Singapore, then this field is not there. If you scroll down, you can actually see what is the dividend paid out, what is the fees you've paid out, and it also tells you what is the composition of your portfolio currently. We also tell you every transaction statement, when your inflow came, when a dividend was paid out, literally everything that you want, is out there, right? And if something is missing, please let us know, because we have built this after extensive feedback and research and two-way interaction with our users, right? So everything that we, can think of is there. And in fact, I don't think since we have launched the REIT product about 2 months ago, or actually close to almost 3 months now, has anyone has asked us for a feature on that which doesn't exist. Some people did ask for a 100% REIT product, and that's the reason why we are all here today. But outside of that, you will find every piece of information out there. If something's missing, we are always improving and always welcoming feedback. Please let us know.
And now that we launched a 100% REIT portfolio, there's a couple of people asking if they can set the floor in the risk managed portfolio themselves.
No, not really. So the risk managed portfolio has a floor of 50, and that's a hard floor, right? So that number can't really go below that, right? I mean, that's it's still a REIT product. If you go below 50, then sometimes then it's not really a REIT product per se, right? So there, that floor is capped at 50, whereas of course we have the 100% REITs option if you want a full REIT exposure, which is what you have available for you.
Okay, and then there's a user asking if he can open portfolios for my defendants under my name.
Yeah, I mean, this is something which requires a little bit of additional paperwork. It is possible to do. I would suggest you reach out either to our advisory team or support at SAIF, and we can guide how this can be done on your behalf, right? So this is a slightly manual process, but yes, it is possible to do if that is what you would like to do.
And then we have a couple of users asking for the risk level of the REIT portfolio. So this apparently are users who are familiar with our global portfolios and are wondering what is the risk, sorry, what is the risk level of the REIT, the 100% REIT and the risk managed REIT portfolio?
Sure. So for the benefit of some of our other users who might not know much about the concept of risk levels and all, with our global product, all users need to decide is how much risk they are going to take. When we say risk, we say that how much are they willing to lose, right? Now, we don't want them to lose. If they lose, they could be unhappy and they will leave. But the point is, if we understand what is your risk appetite, we can build portfolios that give you maximum return based on that risk. And the premise of that, and again, I would strongly recommend if you want to know more, attend one of our workshops on risk management and how we build our strategy. And Richard conducts that workshop alongside me. Is that basically our premise is that returns can't be guaranteed, but risk can be managed, right? And that is something which is what we continue doing, right? So bearing that in mind, in our global portfolio, we can choose between 5 and 25. For the REITs with risk management, we target a 15% number, i.e., this portfolio should not correct more than 15%, right? So that is the band which we are going with. And of course, we do, however, maintain a 50% REIT cap. And that 50% is a higher draw factor for us. So we will keep the 50% as a sacrosanct. And after that, our goal will be to maintain a downside risk of 15% on the portfolio.
Okay, thank you. We have already answered the question on the rights issues. But there is someone asking, what about mergers and similar corporate events?
Yeah, I mean, I think those we'll have to handle case by case. In fact, those it's quite interesting. The beauty is now this partnership with a leading, index provider as the iEdge, right? They are essentially going to be on the top of it, and essentially when these things happen, they will have to reflect it off cycle and off a regular rebalance cycle. So we will actually just take the cue of them, and they are the experts, and they will do the right thing. What I can expect, and if you're talking about the CCT and CMT merger and all that, what I can expect typically is that we will have that merger go through, and when that merger happens, traditionally the index rules of 10% cap should apply, right? If, however, it's a very significant case, and if the index providers decide, and they will have a good reason to do it, then they might change that and make an exception given how big and how valuable that merger will be should it go through. But I think this is a great question for you to ask Simon himself when he joins us on Tuesday, from SGX, right? But the good thing is, we have the industry experts who will guide us when this happens through.
There is a question from a user who asked, like, how is Saif different from some of its competitors? I think we have heard quite a lot of things already which are unique to us, but maybe you can elaborate on this.
I mean, I don't know who else has. I mean, please tell me a competitor who's building something with SGX on REITs, right? I think we are, building out very unique products and very unique offerings, right? And I think the REIT is one, very interesting angle to it. I think the second piece is also on risk management. If you see what we did with our portfolios, where we had rebalanced our global portfolio in the last week of Feb, we genuinely focus on risk management, right? So I would say there is a genuine focus on risk management, a unique proposition with REITs, and this is an example of the uniqueness you will see as time goes by. We are one of the newest, digital wealth managers, but probably have the most unique offerings out there. And third, I think, is a dedicated and also a licensed and a very capable advisory team, which generally can guide you through your investment journey. And those three things differentiate a lot versus, existing customer offerings, right? And experience it to believe it, right? I mean, you will see the change yourself as you become a customer of Saif.
How is it possible that we show 10-year returns on our portfolios? I think this does not only apply to our REIT portfolio, but also on our global portfolio if it's a new product.
Yeah, it's a great question. Yeah. So firstly, when you're tracking an index, you have index data which goes as back as time, right? And given the fact that we are 99.5%, tracking error, we use that same premise and we essentially have these backdated numbers, right? That's the first thing. Secondly, for any new product, right, to see historical performance, there is a very common school of thought which is called like backtesting, where you essentially, go back in time and see how will your portfolios react to the information which you have present. One very unique thing, and you should get on our website to see this, is why our backtesting actually is very effective. And this is a question we even got asked about 3-4 months back before we had made all these rebalances, is that when we backtested, in all our backtesting, we used a very novel and a concept that everyone ideally should use, which is called point-in-time data. What that means is, as of 15th December 2012, the amount of information I had was only till 15th December 2012, and before it, I had no information of the future. Even though I knew it, my models did not know it, right? So keeping that in mind, using this point-in-time data concept, what we do is actually very, very accurate. And this is the same question I mentioned, people asked us 3 months ago, but now they have seen it in action. They have seen what we have done with our risk management approach, not just for our global offering, but also, for our REIT Plus offering firsthand, right? So I think that is the reason why we have backdated information. And that is why you should know. You should know, for example, in 2008, even our portfolios lost money. We are not going to, make money even when everything is bad. But because we were risk managed, we just lost significantly lesser money, right? And which is where, the unique offering of risk management comes in. And this is, to be honest, an interesting topic because in the last few months, because we were risk managed and we kept ourselves, constrained, and, people did not actually see a massive correction in their portfolios. Most of our investors, stayed invested, and now they have reaped the benefits. Most of them have gained, a significant part of their portfolio back again.
Okay, and then there's a couple of users asking about safety of their funds and so on, which I think is understandable in the current situation. How does Saif protect the users' funds?
Yeah, I think this slide covers it, right? First and foremost, right, just the licensing, it's a very stringent license and a lot of requirements, right? There's extensive due diligence which happened on us before we started, but happens on an ongoing basis, which is a constant process where MAS, we have to submit them regular reports, regular audits, and so on and so forth, right? I mentioned about internal compliance, external compliance, internal audit, Big Four's external audit. There are a lot of bells and whistles are, which are in place to ensure smooth operation of what we do. Furthermore, as I said, when you move funds, you don't move funds to Saif. You move it to a trust account, which is exclusively for clients, right? And this is very important because, your funds are kept completely segregated to Saif funds, right? And from that point on, even when you trade, it goes through Saxo, through the custodians, which is HSBC and Citi, right? So they're very reputed, some of the largest names that you've ever heard of. And that is the reason, why your assets are safe and completely independent to, us from that scheme of things.
And then there's a user asking about if there's any promo code, which is why I would like to ask you to share the QR code.
This is the promo code and this is the QR code, right? So
exactly. So please answer a very, very short questionnaire. I just have a bit about feedback. And at the end of the
a little bit of a freeze from Sebastian, but at the end of the little small survey, you will see a promo code. So please help us get better and
for our yes, and Dhruv had exactly enough time to explain while my screen is back. For our international guests, and apparently there are a couple, they're asking, so there's someone from apparently Malaysia and even someone from Europe asking if they can invest into SIFE.
Yes, you can. I mean, the license, the CMS license allows us to, take funds from overseas. I would like to highlight though that for our international clients, the due diligence is a bit more thorough. So, please give yourself another extra couple of days to complete the due diligence. But yes, you can invest both for our global as well as our, REIT product.
I have answered this question a couple of times, but it keeps coming up. So I think we should answer it here. What about SRS and CPF to fund the portfolios?
It's work in progress. I mean, to be honest, as you know, the SRS is granted by the Ministry of Finance, and to be completely transparent, in the last few months they've had other priorities, which, if you ask me, is the right thing to do. I feel once the broader situation settles, they will start reviewing our SRS application. We've already applied, if that's the question, but I expect it would take some time for us to get live and get this application through. So I'm not expecting this to happen in the next, few weeks or maybe in the next month or two, given the situation. But I want to believe that we will have it before, in the next couple of quarters, right? So rest assured, it's a very, very high priority for us. But we have to work with the authorities on this, and which we already are. That's on the SRS piece. The CPF piece is actually even trickier and comes with its other constraints. Immediately, I would say in the next 3 to 6 months, I don't foresee us having a CPF arrangement. We are working on some setups which might allow CPF, but as I said, I don't expect them to come in an immediate time. As they do, rest assured, we will tell all our users, because we understand this is something that they will appreciate as well.
What about joint accounts with my partner?
Yeah, so you can fund from your joint accounts, but the account has to be under one individual's name, right? You can fund from a joint account, and thereafter, if you want to have a separate arrangement that when there's a nominee of their account and all, it's similar to the individual who asked earlier about having an account for their dependents. We can do that as well. It's a slightly manual process, but it is quite easy to process on our side, and with some support from you and some documents, we can actually do that for you as well.
And then there are some questions which I wanted to avoid, but as it comes now up multiple times, I have no choice. Dhruv, how much of your own funds are in SIFE portfolios? And how much is in global versus the REIT portfolio?
I just topped up my REIT portfolio today, by the way. So, but let me see what the split is. The split, I think, currently stands at about 70%, roughly about 70% global and about 30% REITs. 70 or 75% global, 20-25% REITs. In terms of my assets, or in terms of the liquid assets which I have right now, I can assure you that I have about 5 portfolios or 4 portfolios right now on SIFE, right? And my bank account is smaller than any of those portfolios, right? So I don't know if that gives you a gauge of proxy, but you can rest assured that a very, very small part of my liquid assets is actually kept as cash. And this is one thing which we see time and time again. Is that a lot of people essentially end up keeping a lot of cash for emergencies, or what if I need, and it was tough, right? When there were all these funds where you have to pay 3% entry, and if you leave you have to pay 5%. It becomes very, very tough to do. But with setups like ours, right, there is no reason for you not to really invest. And I can understand you need money. Definitely, even we recommend keep like 3-6 months of investment. But in Singapore, we did a survey in December, and almost 45% is in cash, right? I mean, what kind of emergency will require 45% of your net worth, right? And again, if you have a tool to take it out, take it. So keep 3-6 months, of your money, and the rest, you can do. I actually should get a bit better, and I should probably keep 3-6 months, but I'm frankly, just slightly below that benchmark myself. So I need to get a bit better at managing that side of my own investments. But to your original question, it's roughly about 75-25, and I would say, as I said, my smallest portfolio is bigger than my bank account. So I hope that answers your question, right?
Okay, thank you. Is it possible to select specific units?
I guess the question is it possible to choose specific
So specific REITs, I think that's the question.
Yeah. No, not really, right? Because we are trying to basically benchmark and build an index, and with risk management, we're trying to manage that index with bonds, right? So if people have very strong specific REITs and views, I think they can exercise them via brokers, but we currently don't have that option. And in the foreseeable future, we don't even see that option. I mean, we're trying to benchmark an index and manage it from an index basis.
Okay, and then there's a user asking where to find the referral code. Can you please explain this quickly?
So if you end up, referral code. Oh, so if you want to refer a friend, yes, in your app or your dashboard, if you go to the little setting or account button, you will see your referral code out there, and which you can just copy and paste, with anyone, right? So and if they use a referral code, you get the same benefit and they get the same benefit as well. So it's quite good. Definitely use it. If you still struggle finding it, do drop us a note at support@Saif, and we can actually tell you how to find it as well.
Okay, then there's someone asking about the risk management of the 100% REIT portfolio, and I'll try to answer that, which is that you basically have the choice of a risk managed portfolio, which has, as you pointed out before, roughly targeting a downside risk of 15%, or a 100% REIT portfolio, which has no risk management, but all the other advantages of a pure equities portfolio.
Yeah, I mean, just bear in mind, given the fact that even the 100% REIT portfolio is diversified, and there's a very smart and a very capable team at SGX, choosing the right REITs and the right composition, there is some level of risk management that goes into it. But if you're thinking about do we actually change the constituents to manage risk of the portfolio? No, we don't. We try to track the index for the 100% REITs portfolio. We've had a little Sebastian freeze. Let me see if I can get some of these questions answered.
What about hello, am I back? Yes. What about automatic top-up? We have discussed a lot about automatic reinvesting and automatic payouts, but what about if I want to automatically top up my portfolio?
It's a lot of our users use it, and I think it's an incredible way, right, to actually increase your investment subconsciously. The best way to do it is to set up a gyro or a regular payout feature at your bank end. You can put as little or as much as you want, and the good thing is then the control is on your side, right? You can increase, decrease the amount. You can turn it off, turn it on anytime, right? So that is the best way to do it, and that's a channel I would recommend you to do it. If you need help for your specific bank, how to go about and set this up, do drop us an email at support@Saif, and you can mention your bank, and we can send you a little guidebook for free, which can tell you about how to use it and what to go on and how to proceed with the account allocation.
Okay, and I know we have already discussed safety of funds, and you have explained why they are very safe. But what would happen in the unlikely case that Saif ceases operations?
Yeah, I mean, I think it's a fair question, right? If at all, right, that comes to us, right? And I think it's important to highlight that we were one of the most well-backed startups in the region last year, and we have an incredible investor pool which will only grow. When I say investors, like investors who invest, equity investors into our company. So I think we are quite safe from an angle of running out of cash, if that's your concern. But if your concern is what, for some reason you stop operating, what happens to my asset safety? And this is where the trust account and the custody will come into play. As we said, we can't really tag into your or any customer assets to fulfill Saif's needs, right? So if such a situation should arise, typically what happens is two parts normally happen. Either the MAS will intervene and suggest another fund manager to take over our operations, and then you can choose to move to that fund manager in exactly a similar setup. Or alternatively, you can choose to basically redeem all your assets and you can get cash paid out, right? So this is not something where it happens overnight. Whenever there is a closure or liquidation, this is a process by law which we have to follow. And to be honest, there is a base capital requirement and there is a professional indemnity insurance and these extra things that we actually need to maintain all through keeping this license. So there will be enough resources and an insurance to ensure that this transition happens smoothly, right? So it's not going to happen to Saif, but it's a valid concern, and God forbid that does happen. This is what should happen, and this is what you know.
Okay, thank you. I know we covered this last week, and unfortunately, we don't have the slide for this answer for this question with us today. But do you recommend a lump sum investment or some regular savings approach?
Yeah, it's a. I mean, we should really keep that slide in every presentation. I think it's a great question, right? Over time, and I remember the data though, so I can share the data. Over a 24-month period, lump sum has outperformed regular top up in 3 out of 4 cases, right? So there's a 77%, I remember the number, where lump sum outperforms regular top ups over a 24-month rolling basis, right? So you are much, much better off to lump sum than regularly top up, right? That is one given rule, right? Which is always there, right? Having said that, as I said, it is always a function of what an individual can do. So if you don't need the money, time is your friend, go ahead and do a lump sum. If on the other hand, you want to build your arsenal over time, put a small lump sum, but put a regular payment. If you can't put a lump sum, just put a regular payment out. So I'm saying, of course, how do I say? Lump sum is better than the regular top up. But again, I mean, it's better to do regular top up than not invest at all, right? So if you're going to be debating with you and not invest at all, then you lose out, right? But if data has to go by, of course, it's there. Now, bear in mind, right? You could, of course, time the market, and you could have, and we had one of someone, we know, put a very significant amount with us 2 days before, the market corrected. That was just unfortunate, right? But again, because the person was looking at it from a very long-term perspective, he doesn't mind about it. These 2-3 months is just a blip in, a 5-10 year investment horizon, right? So from that angle, always I would say go and do lump sum. But again, if you're more comfortable with, topping up regularly, do that. Data supports lump sum over top up, if that's your question.
And then there is one more question, which is about again about the question about switching from one REIT plus portfolio to the other one. Will Saif sell everything and repurchase?
No, we will only trade the systems are very savvy, very advanced. We will only trade the balance portion which is required, right? So essentially, we'll only trade if, as I said, if we have to move from 50% REITs to 100% REITs, we will not sell 50% first and then buy 100%. That's why you need. Our systems are robust enough; they can support fractional ownership. We'll only buy the balance out there.
Exactly, we'll only buy the balance out, and on top, trading charges, brokerage fees, etc., are covered as part of our management fee, so there's no cost for any client. Then there is someone asking, can we invest into the 100% REIT portfolio now, and then when the market rebounded, switch to the risk managed portfolio? I think we have answered this before. Yes, you can change at any point in time. We recommend to not change too frequently, but choose the portfolio which fits your long-term objectives. If you can stomach higher fluctuations, maybe 100% REIT portfolio is good for you. Otherwise, we recommend a risk-managed portfolio. Then there are a couple of questions around international exposure of the portfolio. Can you maybe elaborate on this a little bit?
Yeah, I mean, so I think the constituents are here. I think largely the focus still remains on, let me see, I might have it here. Right, if you can see, right, largely the focus still remains within, Singapore. but there is a limited, international exposure which is coming through the CapitaLand Retail China Trust, or even the, the Manulife, like, US REIT. So I would say a majority of it is still in Singapore. I don't have the exact number out here, but roughly from what I can see at the top of my head, about 90% or so is in Singapore, and the balance, 10% comes from, overseas, as the case might be. So relatively a small portion is done overseas currently.
Good. I'm going through the questions, and I think we have answered most of them. There's one question which is asking, does SAIF have any other income besides the 0.4 to 0.65% management fee?
No. So if your question is, do we get any kind of kickbacks from the ETF or the different funds and all? Absolutely no. I mean, this is all we rely on, and this is necessary for, for us to pay our team, pay our charges, all the technology, all the system, and all the brokerage costs, as the case might be. And also we don't take any kickbacks, and we don't have any other income besides this that you see right now.
Okay. Then there is a question about does the REIT counter under SAIF REIT Plus the same as IHS REIT 20 index? I think the question here is, or I assume the question here is like, where do you find all the information about the REIT portfolios? Yes, it's both under the REIT Plus section on our website, where you have then two different tabs which allow you to see the different, the different composition, etc., of their portfolio. What about the rebalancing of the portfolio? Is it done by AI or manually, or both?
So this is regarding the iEdge index, or this is about our risk management? If you can ask the user which one he's referring to, then I can specifically, answer. So you can, are you asking the rebalancing of how the index rebalances itself, or how does the REITs with the risk management rebalance? I can answer the question accordingly.
Yeah. I think the answer is, I think we can answer for the risk management part, right? The rebalancing of the index is something which I think on a high level we touched on earlier. And for more detailed questions, I think the best is to join next week on Tuesday, when we have the experts with us who can answer all the detailed questions. So maybe you can just very quickly elaborate on how.
Yeah. So I guess as Seb gets frozen again, how do we actually end up deciding, when to rebalance and rebalancing frequency? So it is completely algorithm driven. It is, it is as algorithm driven it can be, right? Of course, we have our checks and bells in place, right, to ensure that, it makes sense, and it does. But, this is essentially driven from the fact where if your portfolio's risk is outside that 15% band, we will end up, rebalancing it out, right? So, it is basically a blend of, you can call it AI, you can call it algorithm, those are just words at the end of the day, but it is a rule-based setup, and not like, woke up on the wrong side of the bed and want to rebalance today. It does not work like that. It's purely based on logic and not emotions, if that's your question.
Okay.
How are we doing on time, Seb?
Yes. Sorry, I'm just trying to really make sure we cover all the different questions, and there were a lot of them. I think let us try to answer a couple more, and I think then we will try to wrap up in the next couple of minutes. For any question which we missed today, and I really apologize if we did, please feel free to contact us under support@saif.com, or also use our live chat during working hours. But I think another couple of minutes where we try to answer the remaining questions.
Yeah.
I think there were a couple of questions on how is it different to an ETF. I think one really important part is, of course, cost. Can you maybe elaborate on this a little bit?
Yeah, I think like multiple levels. Yeah. So I think firstly, I think cost is actually quite important. I think this is cheaper than most, ETFs out there. Plus, if you add brokerage and, rebalancing and all that stuff, those, platform fees and all, the cost gets very high. I think the other big difference is that there is no ETF which actually tracks the iEdge index. This is the only product right now available which tracks the iEdge index, right? So it's very unique in terms of the index it tracks, right? The other difference is that with a setup like ours, you can automatically reinvest, right? Which you can't do with ETFs and all. And the cost is just prohibitive, right? For you to reinvest in the same ETF again and again, right? And I think the fourth aspect, right? So we talked about a unique index which you can only access through us. We talked about the fact that you can, auto reinvest, your dividends. We talked about the cost, how it's cheaper. And the last point is also you have that option of like, risk management, which you can toggle off and on. So I think those four are very, very compelling factors. I think beyond compelling, I think each one of them is good enough for it to be, better than a pure play ETF. By the way, we love ETFs. I love ETFs. I mean, our entire global portfolio is built with ETFs. ETFs is what I used to do for a living for a big part of my life. But I think for REIT's case, I think at least personally, I think that this option you will see yourself across these four reasons is it's a great option to just do it through us rather than do it through a conventional ETF.
Okay. I think that's really the majority of questions. There's one question about cumulative returns of the portfolios over 3 and 5 years. For this, I would, as we don't have a slide on this, we showed the slide where we have the returns by year, but you can find those numbers on the portfolio page on our website. So if you're going to our website and you choose under portfolio, you choose REIT Plus, you can get those numbers latest before you actually make the decision to invest. You see the exact composition of the portfolio as well as not only historical returns, but also a forecasted returns for 3 different scenarios. One a conservative, one what we believe is realistic, as well as a very optimistic scenario.
That's a good point, right? So not just the past, but also the future based on simulations, right?
Yes.
Great.
Yes, there is another good point. For all the answers which you give here, we'll try to somehow also make them publicly available. The video itself will be uploaded on YouTube probably by tomorrow, and you can watch it again there.
Are you sure they want to hear you and me talk again for like 2 hours?
For 2 hours, yeah. But that's why we have a guest next week. Simon Caravan from SGX, the head of the index services team, will be joining us, who can answer in much more detail all the questions about the IHS REIT 20 index. And I think with this, I would like to one more time remind people also about the questionnaire, which also gives you a promo code at the very end. But I think we have answered the majority of questions. At least I cannot see right now a question which we haven't yet answered.
I mean, guys, if you have any other questions, feel free to shoot them. We'll probably hang around for a couple of minutes. If there's any other question which comes in the next minute or two, we would love to take them. Otherwise, we are always, all details are on the website, but you can always get support at SAIF, and one of us will come back to you very, very soon. So let's give another minute, Seb, and see if there are any more questions that come in.
Yes.
All right. Okay, great. Yeah. So, Seb, shall we call it?
Yes, I think that was a relatively long session. Thank you, everyone, for your time. I hope we were able to answer most of your questions. Thank you, Dhruv, for the presentation. And
this is a bit ironic. Literally, when you're telling people, "Bye, you've been frozen again," but I'll on behalf of Sebastian and everyone at SAIF, thank you all. I mean, this is by far the highest turnout we've had, and I think we have more people now than we've ever had before as well. So thank you for your time. Have a long, and a good weekend. Stay safe. And again, I really hope we've been able to answer all your questions. But if we've not, feel free to drop us an email, either my personal email or support@SAIF, and we'll come back to you as early as possible. We are always improving. So we'll love to have your feedback, whether it's on the product front, whether it's on the webinar. And thank you once again for your consistent faith. Stay safe and stay healthy.